Hello and welcome back. Before we begin, a few very quick housekeeping rules. This session will be recorded and we will be taking audience questions throughout, which means that you can simply scan a QR code that should pop up very soon on the screens around you. You can zoom in, open up your camera function and post any questions you might have in the chat box, and they will appear here on my iPad, and I will make sure to weave them into the conversation. Thank you so much for joining us to hear from Standard Chartered Global Research what is going on in global markets, which, according to this team here on stage with me, is in a tug of war. The US and Europe remain strong economic powers, but they're also facing some strong headwinds. China will continue to be a major force to be reckoned with, but we may not see the same growth that we've seen in past years. And what does all this mean for India? Could this be India's time to shine? Joining me here, Eric Robertson, Standard Chartered's, God, I forgot your title, how bad is that? Eric Robertson, Global Head of Research and Chief Strategist, Kaushik Rudra, Global Head of Fixed Income Research and Head of Asia Research, and Anubhuti Sahe, Head of South Asia Research, all from Standard Chartered. Eric, let's begin with you. You and your team recently published a global focus report entitled What Lies Beneath. And when we were all discussing this very panel not too long ago, you mentioned to me that some of the themes outlined in the report have become even more pronounced. Tell us more about it.
Sure, Lisa. Thank you very much, and thanks, everyone. I think there's a tendency in the global economy, the global financial marketplace, to focus on the headline numbers, the global growth number, the global trade number. We all know that global growth has slowed, but what I think that really is actually a misleading statistic. There is, in our minds, significantly positive stories going on in the global economy. So perhaps the better way of describing the global outlook is one of divergence rather than a synchronized cycle. It is no secret that there is significant economic pressure in places like Europe, the UK, the US because of monetary tightening. But what I think the market has lost sight of is that in 2023 and heading into 2024, some of the major economies of the world will be experiencing quite profound growth. China, we expect to grow well over 5%. In fact, this year we see China growing about 5.5%. India growing around 5.5%, ASEAN growing at 5%. So all of a sudden, you have 2/3 of the global economy growing at 5% plus. Now, in our minds, that is a really powerful economic narrative, but I think in some ways is being either ignored or neglected. The other positive story that I think people need to pay attention to is trade. And we heard this a couple of times from Mr. Subramaniam. Yes, global trade volumes have slowed. There's no disputing that. But if we look at the trade corridors that are exploding at the moment, whether it's North Asia to South Asia or the Middle East to South Asia, we're seeing significant expansion of not only trade relationships, but trade volumes. And I think that will ultimately be an important leg of support to global growth.
Building on the themes of pockets of growth and also some slowdown, Kaushik, what signals are you picking up from credit markets? What are your clients telling you on your travels across Asia?
So there are two different things. I think, as Mr. Subramaniam actually highlighted, what I'm hearing from clients as well. I think there's a lot of interest in India. Definitely, as people start looking at other options, I think corporates around Asia, corporates in other parts of the world definitely have their eye on India, and India is clearly one of the sort of clearly meets a lot of criteria, as was very well articulated in his sort of opening remarks. I think what I'm picking up from the credit markets is slightly more disturbing. I mean, I think we are seeing signs of an economic slowdown in the West, particularly with what we have seen in the last few months around the banking sector. We've seen an emergence of a nascent sort of, trust deficit that we have seen in the banking sector, which clearly means that people will be scrutinizing bank earnings, earning results. All of that will be actually scrutinized a lot more, and perhaps we will have more pressure on that particular space. The second aspect is really around what is happening in the US regional banks. Clearly, we've seen a massive deposit move from the smaller banks to larger banks. Now, when you have such a large movement of deposits from these institutions, their model is no longer viable. And I think that clearly will be something that will come out in the months as we see things play out. But the sectors that they lend to, sectors the regional banks lend to are commercial real estate, SMEs, both being large employment generators, but also I think these are sectors which are highly dependent and are expecting these regional banks to roll over their debt. Now, with regional banks having their own strive, I think that's going to be a big challenge. And the third aspect that we see on this particular front is what is happening with respect to private credit and private equity. And again, we can talk about this in more detail if people have questions, but certainly I think there is stress there. I think there is a lot of things that we can talk about, but one of the things that clearly is very clear is these institutions are big lenders in the economy. With the stress that we are seeing on their balance sheet, that lending will come off. So whether we look at the trust deficit, whether we look at regional bank story, or whether we look at these institutions, private credit, private equity, it's very clear that lending will come off, and that will eventually result in slowdown in the US economy and in Europe to a large extent.
Anubhuti, coming to India just for a little bit, I mean, this conference is all about growth and transformation. So how do you see India positioned vis-a-vis other markets?
I think we can easily say that India at this particular point in time is in a sweet spot. Mr. Subramaniam mentioned about the GDP numbers. Growth is clearly doing much better than what all of us expected. And this is in contrast to a lot of economies which have either started slowing or are pretty much growing at a similar pace as it was in the fourth quarter. Limited exposure to China also effectively means that the momentum in growth can continue for longer vis-a-vis, say, other markets which have higher exposure to China. What makes it, puts it in a Goldilocks scenario also is that inflation is moderating at a very rapid pace, much more. Of course, there is a monsoon uncertainty, but inflation is moderating despite growth holding up better. The other aspect is about the external sector. You know, in the past, India was always on a back foot during events of global turmoil or during periods of high commodity prices, because we are a net commodity importer. With this sharp improvement, there is a structural change in services exports. There is a clear shift when it comes to India's sensitivity to external shock. And I think, I'll not say India is today better placed than rest of the markets, but it is far more evenly placed when we talk about India's sensitivity to external shocks. Last but not the least, I think what Mr. Subramaniam mentioned, policy making with a focus on long term, it clearly puts India, gives India an edge. You know, like the first starting point for any policy making or policy maker is to acknowledge the sore points. For India, the external sector was one of the sore points, you know, whenever there were global turmoils. And that kind of pushed growth on a back foot. With this whole policy trust that FX reserve has to be the first line of defense, I think India has built in greater degrees of freedom to ensure that growth continuity remains even if we see some global shocks here and there. So I think it's really placed well. There are vulnerabilities, but clearly on a much more stronger footing than what was, say, a decade back.
So a lot of optimism about what's going on in India. But I wonder, Eric, when it comes to actually investing in India, I mean, some challenges remain. So when I think about a foreign investor trying to get exposure to this market, how selective do they have to be?
Well, I think there are some operational hurdles, and then also some other hurdles, some policy or regulatory hurdles as well. Those are not insurmountable. And I'll come back to them in a second, but I want to touch or add to something that Anubhuti said, which is that if you compare India today with India and frankly a number of other emerging economies from 10 years ago when we went through a taper tantrum, the dependence on foreign capital cuts both ways. 10 years ago, we saw very clearly how an over-reliance on foreign capital can be a very ugly situation very quickly when there's capital flight. We've seen a significant improvement in FX reserves, and I would argue that even with the roughly 500 basis points of rate hikes from the Federal Reserve over the last year, that we've seen a much more resilient financial market landscape and economic landscape here as a result. Now, for those wanting to take advantage of the positive narrative, there's the public markets and the private markets. On the public market side, there's government debt and access to onshore interest rates. Now, because of foreign investor quotas, there are limitations to how much exposure people can get. There are questions about how quickly there will be what we call index inclusion, in other words, India's bonds being included in global benchmarks. I think the government is taking a very prudent approach, saying we have to recognize that that will bring in a flood of capital. But whenever there's an inflow of capital, you have to take account of the risks of that outflow. There are also credit markets which are expanding significantly, both in terms of depth and breadth. And I think that will remain a key aspect of the India financial market story. And then the public equity markets are also a significant part of the asset class selection. So I think the growth opportunities will be there over the next 5 to 10 years.
Fantastic. Shifting our focus a bit more towards currencies and interest rates, and staying with you just for a little bit longer. So we have seen some US dollar depreciation in recent months compared to the heights of last year. I've also heard you talk in a podcast about potentially the US dollar losing its shine as a reserve currency. I mean, what's your take on that? Is that really going to happen? And you mentioned FX intervention strategies across central banks. How is that all playing out? What do you think?
Yeah, so just, I guess, just to make sure my views are out there, we subscribe to the idea that over the medium term, the US dollar will depreciate on a cyclical basis, which is a very fancy way of saying that for traditional economic reasons, we expect the dollar to continue its decline. But that's very different from calling for a structural decline or even a demise of the dollar. I think the idea that the dollar will lose its status as the trade currency of choice or the reserve currency of choice, I think is, well, premature, I think is the polite way of saying it. But that doesn't mean there aren't opportunities in many ways for other currencies to become viable in terms of their use in bilateral trade. We heard this mentioned a little while ago. And I think for India and for a number of the currencies in Southeast Asia, there are opportunities for bilateral trade to be done in a multitude of currencies. And I think that will go hand in hand with the theme that I mentioned earlier, which is that as we see the expansion of trade corridors, you will also see the expansion of trade agreements, and therefore the more, let me say this differently, the increased usage of alternative currencies.
Makes complete sense to me. Anambhuti, what's your view? What's the outlook for the rupee versus against the US dollar?
Yeah, of course. I mean, that's a must question. So our FX strategy team has a forecast of, if I give the forecast range, it is 82.50 to 81. Now, 82.50 is in the near term. 81, that is a stronger rupee by end of the year. Now, the primary theme running underlying our currency forecast is that we expect dollar to be weaker as we move towards the end of 23 or early 24. So that should help rupee to be a stronger footing. Anything stronger than 81 looks unlikely to us because RBI has this whole strong focus on building FX reserves. They have built a lot from a bottom of $525 billion in October. We are now at 610. But the peak was $690 billion last year. So I think there is still some more room there. So we don't think 81 breaks. And, on the weaker side, maybe we see 83, 83.50. But given the structural shift in current account deficit, our sense is, and RBI is sitting with a lot of ammunition, our sense is this range should be well respected for next 2 or 3 quarters.
So positive outlook.
Absolutely.
Very good. Can we talk rates for just a little bit, Kaushik? In the recent Global Outlook report that I referred to earlier, your team and you were quite confident that we have come towards the end of these rate hiking cycles and that interest rates are not going to go up any further. Is that still the case today?
Well, I think our view is still that we think that the Fed is done. ECB perhaps has to do one more, but inflation has proven to be very stubborn, right? I mean, it is coming down, and the various aspects of inflation which are coming down very nicely. When we think about services, ex-shelter, even wage pressures are starting to come off. So it is actually the Fed's work is getting done. But I think the Fed is obviously very focused on inflation. There is a risk that they can move one more time. Certainly they will pause in the meeting in June, that's our view. But thereafter, it's possible that they move again. But at this point, we are holding the view that the Fed is done. I think inflation is actually coming off and sort of, by the end of this year, should be in a much more comfortable zone. And by the end of next year, I think certainly it'll be within the Fed's target zone. So I think even if they were hiking significantly from here, can they actually bring down inflation to their target zone by the end of this year? No. And I think the risks, on the other hand, have started to go up, as I highlighted, certainly on the banking sector side, on the regional bank side, and particularly what we have seen on the housing market side, with, again, mortgage rates starting to creep up again. All of these things will play into the economy. They will result in the economy slowing down. I think when we hike rates in such an aggressive fashion as the Fed has done or the ECB has done, 400, 500 basis points in just about a year, we really don't know what the economic impact on the real economy will be. So I think our view is that the Fed probably needs to be a little more in how they move from here. I think the other thing I would highlight is that the market was perhaps pricing in too much in terms of rate cuts. And we had been very, very, open and sort of, we've been banging the table for a while, saying that the market has been pricing in too much in terms of rate cuts. And thankfully, the markets sort of priced that out. And now we're obviously pricing in a very shallow move from here in terms of rate cuts for the balance of the year. So I think from that standpoint, I think we are probably fairly priced on the rate side. Certainly on the 10-year side, I think perhaps we have already peaked. Like Eric said, on the dollar side, I think both those things go hand in hand in some sense. And, although we may see near-term pressures from time to time, but I think overall rates have peaked from a longer-term perspective.
I shall keep my fingers crossed so that my mortgage doesn't go up any further. The Reserve Bank of India kept its rates flat in the April 2023 meeting at 6.5%. What can we expect for the rest of the year?
A prolonged pause is what we are calling for. Inflation is coming off, but they would like to get visibility that 4% would be there for good, and not just a number which prints for a couple of months. And so we are calling for a prolonged pause. A risk is that we might see a cut happening if inflation remains well behaved, and if global rates start coming lower. But our sense is that even if we see that risk scenario panning out, the rate cutting cycle in India this time will be very shallow, especially given that the equilibrium level for global rates is likely to be much higher than what it used to be in the pre-pandemic phase. So prolonged pause, but yeah, risk of maybe 50 basis points rate cut early next year, but that's not our baseline scenario.
Okay, thank you. Just to remind the audience, you can post your questions online. Maybe we could quickly put up the QR code for people to scan. None of your questions have come through, which is totally fine. I just wanted to give you the option because I am prepared with many more questions. But if you want to join us, please feel free. Actually, now that I say this, there's one question that's come in, so that's great. Let me look at it. Do we expect the interest rate to go below 1% in the US? So that's maybe more a question for our global team. And just as low as it was pre-pandemic, will that ever happen again, I think is the question.
I'll take the first stab at it. I mean, I think I don't expect inflation to go back to pre-pandemic levels. I think there are various factors which should probably keep inflation elevated. We've spoken about reshoring. Now, reshoring is is sort of balancing of risks. But clearly, when you sort of reshore away from China, that's probably going to be inflationary. When you have quantitative tightening, that has moving away from financial assets into real assets, again, inflationary. And there are still various rigidities in the system which will probably keep inflation elevated for the time being. And we've seen that in various sectors of the economy, which is why we feel inflation probably remains stubbornly high. It's coming off, but it's still high. And which is why I don't think that interest rates are going back to those levels anytime soon. I think if we do get that deeper recession, then there is a possibility that the Fed has to cut more aggressively. But even in that scenario, I think unlikely that the Fed probably goes all the way down to that sort of level. I don't think we are necessarily calling for, even in that deep recession scenario, we're calling for anything like the GFC or any crisis that we've seen in the recent past.
Okay, thank you very much. Eric, you mentioned global trade and global trade corridors. It would strike me that the outlook for global trade is still looking quite soft. So beyond all this gloom, you alluded to it a little bit, what are some of the bright spots that you see?
Well, the first that comes to mind, and this is something that we've written about quite a bit over the last year, is that the traditional framework for thinking about global trade, or let's talk just purely about exports for a second, is that emerging economies export stuff to the developed world. And if you look at the global pie of exports, EM to EM exports was only about 40% of total trade about 10 years ago. Today, emerging economies exports to other emerging economies is nearly 50% of that total pie of exports. And so the data is telling you quite clearly that we are seeing more activity intra-EM. And we heard this earlier in the previous speech. And I think this is really profound for economies like India, for regions like ASEAN, for regions like the GCC, which is this ability to have trade opportunities that are not just dependent on the United States or just dependent on Europe. Now, I want to be very clear. We're not suggesting for a moment that the US doesn't matter anymore. It does. But I think we're seeing very clearly that these trade corridors or these trade crescents are popping up all over the world. And I think that's really going to have an important and a profound impact on domestic economic resilience. On the more challenging side, I think it raises the risk that inflation in some of these economies stays higher than expected, because this idea of creating new supply corridors and building the infrastructure that goes along with that can often be inflationary.
Can we shift as a nice segue into commodities markets? They have been quite under shock and a lot of ups and downs. So what can we expect from energy and commodity prices? Will they continue to fall? Will they stabilize? What do you think?
So I think they've been in a very difficult spot because they've sort of been battling many forces. On one hand, optimism of this China reopening. On the other hand, concerns about what was happening in the US with the sort of banking sector crisis, expected slowdown, to the extent that even the previous Saudi output cut wasn't really, factored into the market to the same extent. I think, if I think about from an oil perspective, and certainly the China reopening should help. So far, obviously, there's been more traffic domestically within China. Mobility has picked up, traffic has picked up, tourism has picked up within China. So I think those are important signals. International tourism from China hasn't picked up to the same extent. And when we look at the data in the ASEAN region, for instance, their tourism is back to somewhere between 70-80% of pre-pandemic levels. When we look at China tourists into those countries, it's around 15% of pre-pandemic levels. So there's a lot of scope for China to sort of pick that up. And I think as that mobility-driven pickup does happen, I think that should support oil prices. Also, I think when we think about the inventory levels in oil, they do suggest that we will have some sort of support in the oil market. So I think oil probably will have a little bit more support. Now, the other side of that equation is metals and base metals and other things. And I think there was a lot of optimism that we saw on the expectation of the China recovery. But now this China recovery is different from what we have seen in the past. In the past, we've seen China recover on the back of investment-driven strategies. This has been very much a consumption-driven recovery. And so this is different, and as a result, and with what's happening in the real estate sector in China, infrastructure probably will be a little bit slower this year relative to what we have seen in the past. All of these things suggest that the metal sector perhaps went a little ahead of itself, now is due a consolidation. It's sort of in the phase of consolidation. But I think eventually once the economies recover, and that's probably a slightly longer term phenomena, the sector will recover in a much more meaningful way.
I would like to talk about China just for a little bit. It is a major economy, and I think it's safe to say that we're near the end of a major infrastructure boom in China. So, Eric, where is this growth coming from in China?
So look, there's a couple of factors that are important today. Number one is the mathematics of the reopening are incredibly important. And what I mean by that is we had an economy that was effectively in and out of lockdown for nearly 3 years. And really the sort of the peak or the worst of that lockdown was about a year ago. And so the comparison between today's economic activity and where we were 12 months ago is really quite significant. I mean, it looks like growth in the second quarter for China will come in somewhere around 6 or 7%. I mean, that's really quite amazing. The more challenging aspect of China's recovery, as Kaushik alluded to, is that the nature, the flavor of the recovery is quite different. It's not being driven by a liquidity binge. It's not being driven by explosive growth in the real estate sector. It's not being driven by an explosion in CapEx necessarily. So there's heavy dependence on consumers and services. But what we're also seeing is that consumer spending in China appears to have changed a bit. There seems to be a preference for lower ticket, lower expense items, and that's keeping inflation quite low. So in terms of the way we historically think about a China recovery, I think we need to be a little cautious about the fact that it may not lead to the sort of boom-bust framework that we've gotten used to in the past. There may be less spillover to other economies than we've seen in the past. Now, hopefully that means it's more sustainable, right? But I think we do need to be aware that the dynamism of China's economy is still there, but the actual explosion in the real and nominal growth numbers may be less ebullient.
I don't want to make this a comparison of India versus China, but India's transformation is clearly kicking into gear. We heard this earlier. We're going to hear this throughout the day today. So global manufacturers are looking beyond China, but can India really ever be the next China?
So first of all, I think, and I'm not blaming you for this, but I think the question that many people are asking is incorrect. I mean, everybody's looking for the next China, and everybody thinks about whether that replacement is another country. And I like to think of it as, where are there other regional opportunities? And as we've heard numerous times today already, India is, as Anubhuti said, in a sweet spot because there are regional trade opportunities, there are regional growth opportunities, and India is finding itself in a really powerful spot, which is that it has the services, it has the innovation and the entrepreneurial desire, which you're seeing here in spades. You are seeing both public and private sector commitment to some of these developments. And the final aspect, and we in research like to think that you go where the money's going and you go where the people are going. Well, we've heard today already about the demographic benefits that are accruing to India, and that really sets it in contrast to a number of major economies around the world. So I think there are a number of tailwinds that are working quite positively here.
Staying on India for a minute, Anubhuti, when we discussed this session, you also reminded me that, the government has done a lot. Mr. Subramaniam has shared with us. So from an economic perspective, what has gone really well, and what do you think really urgently still needs to happen?
What has gone really well, I think this consistent focus to ensure macroeconomic stability. The reason why India is in a good spot today, it's because the policymakers ensure that the macroeconomic stability is not disturbed, whether it is inflation, fiscal dynamics, growth, etc. The other part is, what Mr. Subramaniam again mentioned, continuous focus on reforms, irrespective of the circumstances. So even during the pandemic years, the government was focused on a reform. So GST, insolvency, bankruptcy code, corporate tax rate cut, these, the dividends of these reforms put India in a better place today. Private sector is deleveraged. The leverage there is at the lowest level that we have seen in since 2008. And it's actually one of the lowest if you compare it to host of economies, whether it is Asia or LATAM. So the room for a pickup in private investment, or the ground for pickup in private investment has clearly been laid out. And once there is more clarity on, say, global demand, stability in global demand, I think the private sector investment in India can pick up very fast. What has not done, the list of things which India still needs to do is very long. There's no doubt about it. It's not that every issue has been addressed. Key issue would be job creation. Demography is an advantage, but as long as the population is able to earn income. And it's not only about creating jobs for the young population which is entering the workforce, it's also to ensure that the current population in workforce is productively employed. He mentioned about, Mr. Subramaniam mentioned about agriculture. 40% of India's population today is still employed in agriculture, and the productivity is just 65% of the overall economy's productivity. So there, a lot of work has to be done. Upskilling is extremely important. Only 5% of India's workforce has a formal training. The number in developed markets is almost 10x. Education spend, especially on the quality, health spend has to double. Logistic cost is very high in India. It needs to halve. India has done well. This year in the Global Logistics Index, India has improved its ranking. But again, a lot needs to be done. And I think this was another challenge which was mentioned by Mr. Subramaniam, inequality. He talked about inequality as a challenge, and he talked about $20,000 per capita income by 2047. There is a lot of economies have fallen into the middle income trap because of this whole inequality. It's important that demand is generated consistently, and that requires growth to be more, better distributed. So, that's another challenge. So long list of to-do for India for sure, but yeah. Overall, I think this government is focused, especially given what he mentioned at the end, that we are likely to see more policy measures by October, November this year.
Fantastic. An interesting question came in, Kaushik. I would like to pose it to you. It's around inflation. We talked about stubborn inflation, and it has a bit of a different spin because the question goes whether we think there is a long-term impact of ESG measures on inflation. So all this investment in renewables, is this negatively impacting inflation? What are your thoughts?
Yeah, I think as we move from technology to new technology, to more geared towards sustainability, I think there is probably going to be some reinvestments because there's going to be some capital investments that will be needed. People have found ways to operate, perhaps not sustainably, but probably in lower cost means. So I think that will change. So that clearly will have a bump up impact on inflation. But I think over time that should probably get addressed. I think as we move towards the sustainable side, eventually things become more mainstream, and I think people start operating in a much more, in a responsible way. I think that automatically will result in sort of prices getting adjusted over time. But yeah, near term, it could potentially have a little bit of a knock-on impact. Eric, I don't know whether you wanted to say something more.
Well, I guess one of the things that I worry about, and you touched on it earlier in the previous question on inflation, which is the balance between monetary and fiscal policy. Now, let's say, for argument's sake, that the global economy really goes into a slowdown over the next 12, 24, 36 months. It's my view that monetary policy will be less utilized because of these lingering inflation fears. And so you're not going to see the return of zero interest rates. You're less likely to see the return of quantitative easing. But what that means is that the government, in other words, fiscal stimulus, becomes used as the lever to pull to generate growth. Now, it's very easy politically and socially to justify fiscal stimulus for ESG-related initiatives. But that's going to be inflationary, in my opinion. And so I think Kaushik's absolutely right. The short to medium term outlook in terms of ESG-related reforms is going to have a heavy inflation risk.
No choice, I think, is probably one answer to that. We just have to muddle our way through it. I sometimes hear this speculation, Kaushik, so I want to come back to you just for 1 second around India and the potential upgrades to its sovereign credit rating. And there has been a downgrade discussion. I mean, where do you stand on all of that?
I think, till recently we were talking about downgrade, I think till a couple of years back. I think India is, as Anubhuti highlighted, I think India has actually sort of stayed the course on reforms, did very well. I mean, obviously there was a phase in COVID which was challenging, but subsequently India has actually recovered quite well. The growth story has been very strong, and I think growth is a very important aspect of this whole debt ratings trajectory, right? So I think over time, yes, India should probably be getting there, but I cannot see India getting upgraded over the next year or so. We have elections coming up next year, and I think the rating agencies probably wait and watch to see what happens over this period, and probably feel more comfortable doing any sort of rating move thereafter. But over the near term, I see that probably they're staying the course. I think the negative pressure is clearly off. There was clearly worries from a negative ratings action standpoint. That is no longer the story. I think clearly it's a question of when, not if.
Thank you all very much, ladies and gentlemen. Eric Robertson, Global Head of Research and Chief Strategist, Kaushik Rudra, Global Head of Fixed Income Research and Head of Asia Research, and Anubhuti Sahay, Head of South Asia Economic Research. Coming up next, right after this, is our panel on how India Inc. is stepping up to build a future of growth and transformation. Please do stay with us. We'll be right back. Thank you very much.